Good morning and welcome to the ParkBridge Wealth Management Spring Webinar Series. This program is entitled Qualifying as Qualified Small Business Stock, Section 1202. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. And you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles, or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you could listen to that in Apple, Spotify, or wherever you get your podcasts. Today, we're privileged to hear from Andrew Katzenberg, who's a partner at ArentFox Schiff, based in Washington, D.C. and New York City. Andy focuses on wealth transfer planning and preservation, multi-generational planning, estate and trust administration, nonprofit and tax-exempt organizations, and charitable giving. Among his high net worth clients are hedge fund and private equity managers, business owners, art dealers, and athletes. He also represents clients in forming and managing nonprofit and tax-exempt organizations, including public charities, private foundations, and private operating foundations, and acquiring and retaining their tax-exempt status. Andy has authored numerous articles related to his field and is a nationally recognized lecturer. Andy also serves as an adjunct professor at the University of Baltimore Law School Graduate Master's Program. Today, Andy will be speaking about qualifying as qualified small business stock, Section 1202. And with that introduction, I'll now turn the program over to Andy.
Thank you, Jonathan. I appreciate it very much. And thank you, everyone, for today for joining us this 8:30 a.m. So I'm going to skip over, you all have my slides, but we're going to skip over the state, tax environment. I assume I only have, 25, 30 minutes. And I know everyone hopefully is aware that the exemption level is, 13.61 million, a person. So roughly 27 million a couple. 18,000 is the annual exclusion currently. Each state also may or may not have its own inheritance or estate tax. That was the federal. New York, for example, has close to a $7 million exemption with a cliff. New York doesn't have gift tax. Connecticut has a gift tax and estate tax as well. It's currently coupled with the federal. New Jersey has neither at this point. They got rid of theirs about 6 or 7 years ago, and it stayed that way. So that's the general, estate planning environment when it comes to just estate tax. However, when we shift our gears over looking at something like qualified small business stock, this is an income tax play, which I know if you're a lawyer in the room or a CPA, where clients are looking for value for us to provide is, well, great, the estate tax, I'm dead, but what can you do for me today? And that's what 1202 stock is able to help with if you have it. And that's the question about, do you meet this exception? Now, the history of it is, why was it enacted? It was the Clinton administration that enacted in 1993. It's to encourage growth in startups by giving them kind of this olive branch that if they have a unicorn in some fashion, whether big or small, they're going to get this benefit. And the main industry that originally benefited from this was the tech industry. However, we haven't seen many taxpayers take as much advantage of this section in the past as we are starting to see now, partially because one of the requirements we'll talk about, it's a simple one, it has to be a C Corp. And in the past, C Corps had a barrier of their tax structure that they were at the highest tax rate. They were at a 35% tax rate plus the dividend rate of 23.8% when the money came out. So between those two taxes, we're talking, close to 60% of a tax on your money versus if you were in an LLC, that's a pass-through, being taxed at 35 or 37% was a much better, value, especially if you weren't sure if you were going to qualify or depending how much income you were generating. So because of that, there was actually a discouragement at the time to really have a lot of industries utilizing this and setting on themselves up as C corps, because we often see a lot of our clients start off as LLC pass-throughs. There's also S corps also do not qualify for this in that same way. However, but in 2017, when the new tax act came into effect and lowered the corporate tax rate to 21%, then that barrier for entry became that much more attainable. Because now that you had those two combined, it was a little lower. We're around the 40% tax rate, let's call it, by comparison. And yes, it's a little more expensive, but for the gain you might get on the other side, it's starting to become worth it. And more clients are willing to either start as C corps or convert over from an LLC structure to a C corp structure, knowing that they think that, you know, their company's going to start to turn into a qualified small business sale event, and that'd be much greater in value than maybe the little bit of tax that you might give up on the front end. So we've seen more of it. And because we've seen more, we're getting a little more of an understanding of what we can and can't do. And that's what's interesting. This has been around on the books for 30 years, yet there's very little case law or regulation or guidance around qualified small business stock. We've only seen a littering of PLRs that have started to come out, specifically in the area of, you know, do you meet, you know, are you a qualified business or not? You know, depending on the exceptions, which we'll get to later on. But otherwise, you know, it's really the code that you have 1202 that you just have to read it word for word. And whatever it says is the law. Don't forget, this is a legislative grace that they, you know, they're giving you, that they're allowing you to take this deduction. So you have to be aware, and I apologize if my head or face was in the screen the whole time while I was talking with the slide in the background, but you have to realize that, you know, pigs get fat, hogs get slaughtered. If the word says direct or indirect in the code, assume indirect is all encompassing. If the exception to the rule, you know, we talk about is what it talks about gifting or redemptions for 304. If those are the exclusions, they're exclusive. Don't think there is more there that, well, it didn't tell me I couldn't do this. It didn't say I could. It didn't say I couldn't. Take the position that can't. If you're not covered, then it's not a good place to be for you or your client. I'm never going to tell a client that they can't do something and not be sure that I'm right or wrong, especially when it comes to a $10 million, you know, tax burden that's covered with penalties and interest, you know, lagging, and 2 years later, you know, they lose their entire 10 million savings they thought they had. So with that, what is the requirements, or what is this qualified small business stock? What it is that it excludes between 50 and 100% of the capital gains on either the first 10 million of gains or 10 times the basis of the stock. Now, usually you would end up with the 10 million being the most common place to be. Most startups, the founders, they're putting in $10,000, something minuscule. It's really their sweat equity is what they have. Their brain power is what's creating it. So they're going to be the 10 million exemption limit is what they're going for. Sometimes a secondary buyer, you know, in a private equity company investor that's putting seed money as this thing's growing, who buys in for $2 million and gets, you know, new issuance of stock from the company. They, on the other hand, who also may have qualified small business stock, they might have, you know, stock that has a basis, like I said, of $2 million. So they have a $20 million qualified small business stock exemption rather than 10. That's the category that falls there. Then the last piece is, okay, you mentioned it was between 50 and 100% of the capital gains on that first, that's again, used for all my examples, will be that first 10 million. There is a range there. Anything that is pre-August 11th, 1993 is not qualified small business stock, period. Doesn't qualify, and that's it. There's no more analysis that needs to be done. If it's post that 1993 date, it's 50%. If it was incorporated post August 11th, 1993, if it was incorporated post February 18th, 2009, it moved up to 75% via the Obama administration. And then they also did it again in September 28th, 2010 to 100% of that capital gain. Anything incorporated after that September 2010 date gets that full exemption. Now, one of the things you might need to be aware is that for those companies that are from 1993 and before 2010 to 1993, where there is some of the 10 million that isn't covered, based on how the code's written, the piece that is subject to tax isn't subject to tax at the current capital gain rates. It's actually subject to tax at the old capital gain rates of of special stock that it's a 28% rate. Anything under that 10, not at the 23.3% that you would normally see when you get to the newer stock of after 2010. Everything above the 10 million is going to be at that rate, but everything that's below that that's taxable will be at that higher 28% rate. So be aware when doing a calculation that you take that into account. Also, you need to consider that state implications. Some states have mirroring statutes for qualified small business stock, which allows the seller to not only get a federal exemption on that 10 million, but also a state exemption on the 10 million. Some states have no income tax, Nevada, Florida. So again, doesn't matter if they have it or not, it's a zero. Some states don't. Some states don't have it, so you might not be paying a federal tax on your sale, but you're still paying actually the state tax of 6 to 10%, whatever it may be. So be aware of that. And lastly, this is reported all in Schedule D of the client's 1040. So that's where it shows up. It gets reported that there was a sale of $15 million, and then you get to say this 10 million is excluded under 1202 stock exception, and then it wipes it out and you're left with the 5, and that's what you get taxed on. So that's what it does. Now, what are the requirements that we're looking at here that are most important? So the seller must be a non-corporate taxpayer. The stock must be held for more than 5 years. There's no disqualifying redemptions, and it's actually a qualified small business. And so we're going to break down each of those a little more in depth, and I think that's the real focus of today's topic. Because again, those all from at first blush look pretty simple, but they're not quite as they seem. So first, when it comes to the non-corporate seller, this one's half easy, half not. First part, this can't be a C corporation. That can't be the selling entity. It has to be something else than a C corp. All right. So the seller, it can be an individual, it can be a trust, it can be a partnership, it can be an LLC, it can be an S corp. All those are fine. Okay. So that's the simple piece of the equation. The harder part is that people aren't aware of is that a pass-through that you have to hold that for more than 5 years. So the pass-through has to hold it for 5 years, and the taxpayer has to hold that interest in that pass-through for that entire period. Okay, you can't be one of the things we don't want to see is like a radical company where, oh, I have an insurance product and I sell it to them, and they give me money, and then they go get the profits later when the time comes. This isn't a play, to kind of enrich everyone out there. It's really a play for the original person who did the deal, who helped with the investment, who helped grow the business. So if you can't go buy something that's about to mature at year 4, or you're the founder and you're like, I don't have time to wait, so I'm going to sell it to this company, and this company's going to take it from me, and I'm going to get paid, 75 cents on the dollar because I need the money now, and they'll get the balance, in a year and a half when they actually sell the company when it's 5 years matured. That doesn't work. We're not allowed to do that. Again, it's not designed. We don't want to be. This isn't to be abused. So you just got to be aware of that. Another thing with the pass through is that, and this goes just to transfers because you really can't transfer this stuff. If you take qualified small business stock and you drop it into a partnership or an LLC, that terminates its QSBS treatment. So you can't do that. If you think you can, it doesn't work. It's not allowed. It's not okay. So, once whoever's holding it from the start is the person who needs to be the one that holds it after that 5-year period to be the seller. Now, next up, you have, and I switched the order. I apologize. What is disqualifying redemptions. Now, with disqualifying redemption, remember the goal here, and someone actually asked me a question, which I will email back. I promise you, I think it was a Howard. I'll email back to you. Someone asked me about redemptions and the difference between indirect and kind of the wording of it. The reality is the goal is to encourage investment into this company, and the use, when you look at what the qualified business is, that the money has to stay in the business to be used for the business. The goal is not to see money come out. So when money starts coming out, that's going the wrong way. And that's, saying you're not following the rules of QSBS rules that you're trying to keep this investment, keep this product creating something. If you're taking money out, that means you're helping yourself and not the product. So there are three places where redemptions are problems. First is a related party redemption. It has a 4-year window, 2 years before the issuance and 2 years after the issuance is where we're looking. Again, this is a redemption directly or indirectly. Indirectly, think of it as expansive as you want to think it. Anyway, this is, if you think, oh, maybe if it even touches it, it's indirect. It's whether it's through another layer of LLCs or corporations or family members, however it is, all that counts. If there's redemptions, related party redemption, it's a problem. There is a de minimis exception to that. If it's over, it has to be over 10K of value, and more than 2% of the stock has to come back. So if it's below that number, you fall in the de minimis, can't say it, the de minimis exception applies, and it wouldn't be disqualified for the related party redemption. Same applies for significant redemptions. So again, but this is a 2-year window looking 1 year before, 1 year after. Again, this has nothing to do with, family members or related entities. This is third party that you're selling out to some third party, the stock that you have. And so this redemption is a 5% of the aggregate value of all stock at the beginning of the period. That's what's using. But when you're looking at this, the purchase value is the date used against the start value. So again, if the start value of the stock at the very inception, was $100, and the purchase value, is $1,000. Again, it's going to make it very easy quickly based on that growth to go over that 5% aggregate value. So again, it's discouraging, the redemption. And last is a 304A redemption. This is a merger of two companies controlled by the same people. It's deemed a stock redemption when you do this merger. They're not essentially not going to kind of let you play around with the rules to kind of do this. So you got to be careful there. If there is any kind of change in the structure of the entity, that's when an analysis needs to be looked at. We do get clients who come in and ask us all the time, am I qualified small business stock? And when we look back and say, well, what's your corporate history? What were you? Well, I did a merger. Ooh, that could screw this up. Or I was an S Corp, then I became I was a C Corp, then I became an S Corp, then I became back to a C Corp, and now I want to sell. And maybe that also messed up some time periods. Specifically, the holding period may be come into jeopardy. Now, the next one thing we want to talk about is the holding period. We talked about the basic. It's got to have it for 5 years, okay? That's the minimum line everyone starts with, everyone knows about. Now, if you convert from a C Corp into a C Corp from like an LLC, the date of election is the beginning of that holding period. So if you had a company on day 1, and then 3 years later you convert it to a C Corp, and then you get to year 5, you're only 2 years in to your holding period. It doesn't count for that first 3 years. Doesn't work. Then secondarily, again, the stock must be received for money or other property except stock or as compensation. So you can't, again, swap it for stock. Then there's the tax-free exchanges. This is where when someone says, okay, I had this for 5 years, am I able to move it in any way? And these are these are the exceptions to that ability to kind of transfer to some other party than the original issuing party. So the first one is going to be, a gift or request. And in all these, the transferee is treated just like the transferor and takes the property in the same way that they had it. So if you had it for 4 years and you give it to this person, they will also be at that 4-year window. They will take all the characteristics that you had when you gave it to them. So gift and bequest, they tack the holding period for the beneficiary. This is in a lot of other areas of the code, makes sense. It's logical, especially in the sense if you die, you have no control over that. It has nothing to do with you. The fact that it had to go to the next party, that's okay. So that's one. Those two are one exceptions, which obviously makes sense. That's how you're able to do, later planning. I'll talk about for maybe a minute on stacking, where you gift to trusts. Then there's distributions from a partnership. So if you're a partner of a partnership that's held the QSBS, for 4 years, and as I talked about, you can't drop it down to the partnership. And the person who owns the partnership has to hold that interest in 5 years since the inception that the partnership has been holding it. If the partnership is going to dissolve, say year 4, and pushes up, doesn't even have to dissolve, but pushes up everything to the partners or a partner, that person will take the continuing holding period, the transferee kind of basis in the distribution. So that's okay. And then you have a section 351 tax-free merger or section 368 tax-free merger. However, when you do those, the gain is limited to the tax-free event, not the later date value. So if you do the merger on date one and the value of this merger for your interest was $8 million, so you have $2 million kind of left over that you wish you maybe could have had. And then there's a sale of the further company 5 years later, and you went netting 15 million. Well, you're still going to get the same $8 million QSBS, exclusion. You're not going to move it up to the first 10 because now the thing you sold is worth 15. So remember that. And like I pointed out, this does not include contributions to partnerships, section 721. So normally that isn't a realization event when you contribute to a partnership and you get back in return a partnership interest. That's an exclusion, from the tax code perspective. But from this, it is not an exception to a tax-free exchange. Another place I want to point out of uncertainty, again, these are the specific statutorily blessed tax-free exchanges that continue QSBS treatment. If it doesn't fall within this, it doesn't count. I would not do it. So, for instance, if you have a trust that owns an interest in a QSBS entity, is a distribution from the trust to the beneficiary continue that transferor's, continued basis to the transferee? Maybe, maybe not. I would not bet my life on it. I would not bet my client's $10 million exemption on it, or exclusion on it. Again, don't forget, the code specifically acknowledges a distribution from a partnership, but it explicitly does not say a distribution from a trust when it could have, but it didn't. So the legislation, arguably I would say is clear that it doesn't qualify, but logically you would think, why shouldn't it? And shouldn't there be, a lot that you would hope? Maybe that's an amendment. Maybe that could be added, maybe by regulation. But again, there really are no regulations here. That would be something that you would think should qualify logically, but there's nothing saying it does work. So I would not advise telling a client to do that and thinking when he goes to sell it after the fact outside his trust from a distribution that he's somehow still qualifying. And then lastly, there's a section 1045 exchange. Essentially, if you have a QSB stock that you sell and it hasn't actually hit the 5-year period, you can reinvest it into a replacement QSBS entity and will continue that further holding period. But you must do this within 60 days of the sale. So you have to have something lined up, ready to go in this context for QSBS treatment. But again, if you've only been at 3 years and you're like, oh, the 10 million didn't qualify, I'm going to go get a new company, I'm going to stick it in there and it'll get to the 5 year, 2 more years, I'll get to the 5, it will sell, and then I'll get a full exemption. Great. But at the same time, just like all the other kind of tax-free exchanges or other tax-free kind of events like qualified opportunity zones, that they're great if you can find a good one. So, just because you can move it and save the money doesn't mean the next thing you're investing in is a good investment. So you always have to be a little wary that that's going to work for you. Next we have is the qualified small business itself. Well, what is that? Again, it must be a C Corp. That's it. If it's not a C Corp, then we can stop the analysis. The gross assets cannot exceed $50 million through the date of issuance of the stock. This includes the amount you received for that issuance. So if you, put in, if a buyer comes in and gives you $100 million, well, they're not QSBS because they gave you $100 million. Whatever they give you plus whatever the company is worth at the time combined, that has to be under the $50 million threshold. Again, focusing on the startup. And then lastly is the active business. This is the piece that has the most to it. So an active business, you must be active for substantially all the holding period. There's no guidance on the test of what substantially all means. However, when you look to other code sections, this normally is defined as 80 to 90% of the time. So again, if you are not falling in that category of 80 to 90%, I would not believe you are QSBS. 90 being the preferred number, 80 probably being fine too. The next is that 80% of the value must be used in the qualified business. Again, you can't, the point is everything that's being put into this is being put towards this business. You can't have it sitting on the sideline being passive. Again, there's no guidance on how you calculate this. Is it an average? Is it constant? How long does the average have to be? Is it over a 3-year window you look, or a 5, or is it over the entire lifespan of the entity? No one's really sure. Again, you got to at least be above 80% no matter which calculation you use. That's a minimum starting point. But the best case is it's a constant. That's where you want to be, is that every year 80%, because then there's no question that maybe you don't qualify, which is, again, where you want to be. Generally, the active business, what is or what qualifies as one, follows the section 162 definition. So this is the starting point where we look. And the reality is, when you look at what meets the exception, what isn't an exception, what you want, there's a cross-reference actually in 199A for the real estate deduction that was from the 2017 Tax Act, that cross-references what's considered, it says whatever is a qualified small business stock entity or active business for 1202 purposes is a 199A active business for that code section, even though there's nothing in the active business code section for 1202 that actually says what is or isn't. So you can actually look, and there's been rulings on those of what's qualified under 199A, which logically would imply that it qualifies for 1202. However, these are PLRs, so they're not guarantees that they work, but they should work, and at least gives you a sense of, the likelihood the IRS would disagree with its own position. It's probably small, even though PLRs are not binding on other taxpayers other than the taxpayer who's given that PLR. It's something to be aware of. Active subsidiary attributed to the parent, if the parent owns at least 50% of the subsidiary. So that's okay. So again, if you have a holding company, it drops down, owns some other, the active business, that makes it, okay for the upper tier. Less than 10% of the assets consist of real estate, not used in the active trade business. Less than 10% of the assets in stock and other corporations that are not subsidiaries. Again, the point of this is that we want active businesses, not things that are passive. Both of those are too passive to qualify. We don't want you to, again, be just a holding company. Rev Proc 2024-3, there are no letter rulings on active business requirements. So you're not going to be able to get more information than just finding out on the fly with the IRS. So that's kind of, why you have to look to these other areas to determine what is or is not. Again, active business exclusions, ineligible businesses, DISCs, regulated investment companies, REMICs, REITs, cooperatives, they're just ineligible. They don't count. Doesn't matter if they hit all the other qualifications, they're just excluded. And then there's ineligible trades of business, performing professional services, banking, investment, farming, hotel, restaurants. So in going to the first one, performing professional services, law, health, accounting, consulting, essentially something that your skill and reputation matters to. And it overlaps, again, talking about section 199A, what is ineligible and what is not. You can look to that for helpful guidance. Now, as we wrap this up, there's been a lot of PLRs on, well, do I qualify or do I not? And there's, if you're uncertain or there's a colorable argument that you could be an active business, it's worth getting a PLR. Because there's all these listed here are a handful that you initially would say, well, that's in health, a pharmaceutical company, or medical devices, or maybe a brokerage services, again, or doing consulting in some way. You would think that these would not qualify, but they actually can. This one PLR at a pharmaceutical company was in the healthcare industry, but didn't fall with that because its services were broader than just the healthcare industry. Preparing reports didn't fall into a healthcare exception because they weren't relying on their skill and reputation for the medical device. They were just running the diagnostic and handing it over to a third party who, doctors who were doing billing, who were doing the diagnosis, who were talking to the client. Company was not, again, so it was providing a physical service. Again, all of these, places that you would think that you wouldn't qualify, you might. So again, it's worth getting a PLR if you think you can kind of maybe fall within one of these exceptions. And then the last thing we'll touch on just for like 2 seconds, if now that we've determined where QSBS, great, you get your $5 million, you get your $10 million of exemption, hopefully all 10 million, 5 to 10 million, whatever it may be. What can I do with this? How many do I have? Do I have just one? The answer is each taxpayer is entitled to this exclusion. Spouses are, I could go much along in depth in this, but spouses are considered the same taxpayer. So husband and wife, they are one. Anyone who's like, well, I've heard this argument that if I do, they, if I separate them, they each get 5, but if I do a joint return, maybe can I take 20? The answer is no. No, 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 you can't. If you do, your client's probably going to get clobbered. or maybe just IRS hasn't caught you, but we don't speed not to get caught. We just don't speed. Separate taxpayers, again, include relatives and non-grantor trusts. So any of these people you could give to a sister or a brother or a parent, they too can receive that 10 million exemption. And the non-grantor trust, this is where you hear about the term stacking, where you're able to multiply your exemption by a part amount of X, who knows, depending on how many trusts you can create, but they can't be identical trusts. That's the big catch-all. 653F, that's kind of the linchpin there. You must have different primary beneficiaries, and they can't be substantially identical, these trusts. In that sense, the grantor and the beneficiaries. So if you have multiple children, 3 kids, you could create 3 trusts, one for each of those kids, and they'd have obviously unique beneficiaries, son 1, son 2, daughter 1, and each of those trusts in a non-grantor trust fashion would be able to receive that additional $10 million exemption. So in that case, you get 10, you and your wife, your kids would each get 10, you'd have a 40 exemption for the first 40 of whatever the sale is, and you're doing great. You've hit a home run. Again, there's a little more to it than that, but that's kind of the basics. I know I'm at time. So I want to thank you for that quick blitzkrieg of qualified small business stock history and requirements. And I'll turn it back over to Jonathan. And again, thank you for everyone for joining me today.
Great. Thank you so much, Andy. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Andy or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my spring webinar series continues on June 11th on the topic of marital myths, the importance of planning, preparing, and protecting for families before and after a loved one marries, featuring Lisa Presser and Brian Balduzzi, both of the law firm Fager Drinker, based in Philadelphia, Pennsylvania, and Princeton, New Jersey. And I'll send out an invitation to this program in the coming days. In the meantime, if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Second, you could follow all my work on X or on Instagram at Jonathan on Money. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my new daily financial planning videos by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.